thank you for wearing a black shirt, first of all. We've had 3 podcasts that we've recorded. You're the third. And every guest has had a black t-shirt on, including myself. So whoever's next, you got to make sure you keep the streak going because it's a very normal thing now on the podcast.
It's literally like a Millennial Uniform now. So maybe that should be the name of the next podcast.
Yes. Yeah, Millennial Uniforms. We should talk about that. But yeah, the black tee has become very popular. If we were really smart, we would have started a black t-shirt company like 5 years ago. But thanks for being on the podcast. Really appreciate it. Love to maybe start out by sharing with the audience how we know each other, how we met. So
yeah, sure.
Faizan, tell everybody how you say your name.
I get all of these, but Faizan is the pronunciation that kind of stuck with me when I moved here.
I still think I've known Faizan for a few years now, and I still think I mess it up. So, but it is Faizan Bhatty, correct?
Yeah, last name's a little bit harder. So it's Bhatty. It's a Pakistani pronunciation, but
we're not going to try that. We're going to trust that one. But Faizan and I met through a mutual friend a couple of years ago, right around the time that his company was acquired, and really excited to have you on the pod and share more. So to get going, why don't you just share with everybody who you are? Let's hear a little bit about your background. And, I think maybe your upbringing up until the time that you went to Wharton.
Yeah, of course. Well, one, thank you for having me. It's an honor, and obviously it's always fun to do these with friends that I've known for some time now. So as mentioned, my name is Faizan. I moved to the United States about 12 to 13 years ago. So I'm a very proud U.S. immigrant from Pakistan. I grew up in a house with a fairly large family. So my grandparents lived with me. So from the get-go, community was a large part of how I grew up. Was very, very close to my grandparents, or like second set of parents for me. And grew up surrounded by physicians. So a lot of people in healthcare. Both my parents were physicians. My grandmother was a physician. And that's kind of my early childhood. Was not really exposed too much to the business side of things. And left Pakistan as the first one in my nuclear family to the United States. Came here for college. Went to Emory University in Atlanta for my undergrad. And had just a phenomenal time there. I think those 4 years were the most formative years of my life. Learned a lot about just how the country operates, how the world outside of my small world in Pakistan operates, and learned a thing or two about what I wanted to focus on. Fast forward to the end of college, I started getting interested in marketing and happened to convince Google to have me as one of their business associates at the prime. Had a phenomenal time at Google, spent about 4 years there. And while I was there, I kind of started delving a little bit deeper into marketing and ad tech. So that's where and we'll talk more about this too, but that's where the initial idea for building a business came from. And from there on, left Google, started business school at Wharton. And at Wharton, I met my co-founder, ended up dropping out of the business school program and creating a company. And within a year, exited to Lyft and have been at Lyft it's been a little bit over 3 years now, but now I run a team called Lyft Media.
Wow. Okay. Amazing. Let's unpack some of that. I didn't realize you were the first in your family to leave Pakistan.
I was, yeah.
To come to the U.S. So I have a few questions on that. I think one of them is, I have friends that live outside of the U.S., and many of them have a desire to become a citizen of the U.S. Was that your desire? Was the U.S. itself something that was intriguing to you, or was it the opportunity to attend a specific school? Like, what was it about the U.S. that intrigued you, and why did you want to come here specifically?
Yeah, a couple of things happened. So one, so much of life is just the opportunities that are presented to you and the cards you're dealt with. So I got very lucky. The year before I was applying to colleges, it turned out randomly my family and I received green cards. And the backstory for that is that my father's sister applied for sponsorship for my family about 13 years before that.
Whoa.
And coincidentally, the year before I was applying for colleges, I had this golden ticket landed on my lap. And I felt so lucky and privileged to have that. And I said, this is phenomenal. This means I can now qualify for need-based scholarships. And United States is expensive as a country, especially when you're coming from a developing country.
Yeah.
College here is outrageously expensive. It always has been. So for me to attend college here meant that I had to come on a pretty generous scholarship. So applied pretty liberally I knew nothing about what I was applying for, but basically I still remember went to, I think it was businessweek.com/college rankings, and then went for like the top business schools and applied to all of them. And then whichever one gave the best package, that's the one that I was going to go to. So that's how Emory happened. So it was one of the best lucky mistakes I've made in just randomly applying instead of looking too deeply in, but it ended up working out for the best.
That's incredible. Now, since you've left, have you had other family members that have followed you? Do you have siblings, aunts, uncles, anybody else that's come?
Yeah, so both my sisters also moved after I did. So it's we all live in different parts of the country, but it's been really fun to have them here. So I don't have to travel, 20 plus hours to go see my nuclear family anymore.
Amazing. So you did your undergrad, you got hired at Google. Eventually you decided to do your MBA, right? You went to Wharton for this. Very prestigious master's program for sure. What made you decide to want to do that versus, you're already at Google, right? You're probably already learning a ton. I think a lot of people, when they get into that sort of opportunity, they go, there's no point in getting my master's or my PhD or continuing my education in the more traditional way. So what made you want to go back and do a master's?
So, after spending 4-ish years at Google, and before that it was 4 years in undergrad, I was still learning a little bit about how the country overall operates, like how the business side of things operate here. And towards the end of my Google tenure, I was learning that this country really does reward risk takers. And you have to take a risk in order to accomplish whatever you're trying to accomplish. And just the way the structure is set up, it's building businesses is something that's very feasible here. We can talk more about that in a little bit too. But that's where the inspiration came from, that, I want to build something. I see gaps in the ad tech world that I operate in at Google, and I'd like to build a business, but without taking, at that time, what I saw as a huge risk of just giving everything up and going and building something. Instead, business school, ironically, it provided a very neat safety net. So I figured that you're already in a place where you've left your job. You're already surrounded by a lot of people that are kind of like-minded, a lot of people that are there for some kind of a reason or purpose. And it's a very natural place to start a business. You have a lot of time on your hands. You have a lot of these incredible resources. You have around professors in your fingertips. So that's where so business school to me was always a means to an end. And the end was just to start a business.
Let's talk about one thing you said there, which is, you moving to the U.S., you realize that there's advantages to building companies here. What is it about the U.S. in your mind as an immigrant that makes it easier to build a company here versus, somewhere like Pakistan?
Yeah, look, like no country's perfect. We know that, but I'll be the first to say that the United States does offer opportunities to immigrants that, in my eyes, no one else does. And for me, that's speaking more so from the perspective of an entrepreneur. Yeah. You can move here without much of a network, without a name for yourself, and then you can build something kind of out of nothing just by proving to the world that what you're building is valuable. There's incredible capital opportunities available where you can go in and finance companies in many ways. There's a lot of trust baked in the system that it's okay to fail, it's okay to try things, and it's okay to learn from them and then keep iterating until you find the right opportunity. So having spent some time in ad tech at Google, I started getting exposed to some of these gaps that existed. And I wanted to build a business that kind of filled one of those gaps. And it became more and more clear that the availability of capital was there. And I think it is somewhat unique to the United States, where you can go without being a second or third or fourth time founder. A first time founder go in and say, I have this idea, I have this team, and here's how I plan to execute it. And here's an MVP that I built just from my savings or a small grant that I got, and here's the results that I'm seeing from it. If you can cast that narrative to an investor, create kind of a compelling pitch out of it, there is a lot of opportunity there. So I think America overall it kind of attracts that type of talent, people that are willing to jump out of their comfort zone and take a certain risk or two and just build something. And that something could be significant, it could be insignificant, but the whole idea behind learning from the process, I think, is very unique to the country.
Such a great attitude. I think it's easy in 2022 to have the victim mentality, especially as a immigrant into the U.S. You see a lot of people saying, like, I'm an immigrant, and so by default, I don't have opportunities, and yours is quite the opposite. So, obviously you've talked about a lot of the, I think, good parts of the U.S. and the opportunity and the things that were created for you, but what were maybe some of the challenges that you had being an immigrant? Because I know it probably wasn't all, roses the whole time.
It's fascinating. So I hear a lot of stories from my coworkers and some of my friends that also had similar stories, similar backgrounds as I did. And everyone has a different path to it. For me, the challenges were more so in terms of cultural integration. So moving to a brand new culture where you're still learning how things operate, that's where the challenges presented themselves. For example, if you move to a place where you don't even know what the how like basic tenets of the business operate, it takes some time to ramp up. So the challenges that I faced were very organic challenges that anybody else would have faced. I didn't face anything, to be quite honest, that I would say is what was a deal breaker. It was, or maybe it's part of the attitude you take, but to me, it was all just, I came here and I was just amazed with the opportunities all around me. So even in college, it just felt like if you're willing to do something, the rules kind of bend and shape in a way that you can go build something. You want to start a club, great, here's resources, go start a club in college and have other people participate in it too. So a lot of the early learnings came from just being there, moving to the US and learning that it's just taking a few risks or taking a few just steps here and there out of my comfort zone equal amazing learnings. That's
a great attitude. It's a great playbook, I think, for other immigrants coming into the US as well. So you do your undergrad at Emory, you do 4 years at Google. At what point did you realize you wanted to build a company? When did this happen?
A couple things happened. One was, I think you and I both tend to be this way. We're somewhat growth-minded. You are always thinking about the next step. As soon as you get to that step, you think about the step after that. So for me at Google, I got promoted a couple times. They told me there were early promotions. I said, great. But then I wanted to eventually become a VP. That to me was like, if I can be a vice president at Google, then I can have the impact that I want to have on this overall structure. You have this, at that point, it was a 50,000 person company. So a lot smaller than what it is today. But even then, it felt pretty big when I was there. And I didn't just want to be one piece of a large equation. So the natural step was I just emailed my VP. And this is a person that, was 5-6 layers above me. And I said, what can I do to be in your shoes X years from today? So he set up a meeting with me and he told me that honestly, there's not a structured path for you to become a VP at Google. Here's all the stuff that needs to happen. And if that happens, one spot might open up. So it just was, it wasn't the answer I was looking for in a way that I wanted a clear path to progression. And when I didn't see that, I said, okay, then what else is out there? And that's when I started looking into the gaps that I was getting exposed to just through my daily work in ad tech and in marketing. And that's also coincided with a time when I started realizing that it's not that difficult to build a business. There's a whole facade around the difficulties of starting something. It's not like how it used to be in let's say our grandfather's generations or grandmother's generations, when you had to go to a physical bank, convince them to take a loan that's personally guaranteed, and you go and set up like a factory to do something. The cost of setting something up and cost of basically getting an MVP out there is quite low. So all that combined, I said, well, this is the right time to start a business, and business school offers a good safety net for me able to do that. And that's when I decided to leave Google. So one, no upward mobility, at least the way I wanted it to be. And two, just this realization that in order to truly realize the dreams that I have to build something.
Yeah, amazing. So I think there's a lot of entrepreneurs out there that are probably listening to this right now who think they want to be an entrepreneur. They have that sort of growth or builder mindset. Maybe they don't know exactly what they want to do, right? It sounds like that was you leaving Google. Maybe you had some ideas, but at what point in your tenure at Wharton did you realize, like, I want to build Halo cars? What was the concept for Halo cars in the beginning? And, I think the other thing I want to get into was your co-founder selection. How did you decide which co-founders, which people you wanted to work with on this business?
Yeah. So on the first part, on deciding what to do, just at a very broad or very high level, I know you and I have spoken about this past at dinners too, but I fundamentally believe for every human out there, there's some roles or some capacities that they can excel at.
Yeah.
So you can be good at a lot of things, but in order to truly hit something you're excelling at, that also has to coincide with something you're interested in. So if you draw that Venn diagram, you want to play right in the middle, where you have a very high degree of passion, almost to the point of being obsessed with something. Mm-hmm. And at the same time, that something can create an opportunity for you. There's a gap in the current structure that you can uncover, but something along the lines of that's something that you want to build a business in. So the overlap of those two is where ideally you want to play. So for me, that was in ad tech. So I dedicated 4 years of my life at Google in just learning everything I could learn about ad tech, how the bidding processes work, who are the companies that are spending on these different networks, how much are they spending, what drives them to spend in these kind of networks. And that's when I realized that at Google and all the other ad tech platforms that were coming up, all the digital ones, there's a very high bar for what needs to be met in order for these large companies to spend hundreds of millions of dollars per year on ads. And the bar is everything needs to be tracked, measurable, targeting needs to be very precise, and everything that we know about the sophistication of digital ads needs to be present. At the same time, these exact same companies were allocating significant budgets to out-of-home advertising, which includes the billboards, bus shelters, taxi ads, things like that. And there was no targeting, no measurement, none of that stuff. So that's when it kind of clicked that there needs to be a world in which we can bridge these two, where the sophistication of digital ads can be brought into the actual impression delivery and the spread and the scale of the out-of-home ads. Because the out-of-home ads still have a purpose. Billboards do still work. We just need to find a way to target them better. We need to find a way to measure them and actually be able to quantify the impact that you're having from these campaigns. That was basically the thesis of building Halo at a very high level. The second part of it actually came from business school. So after I started business school, so about my second month, business school is basically a plethora of events happening all the time. It's like a large social experiment. You have 800 people. There's some structure to it, but mostly it's like, here's these 10 events happening every single night. Pick the ones you want to go to.
Wow.
And I remember I was in a Lyft/Uber. I can't remember which one exactly. It was a rideshare vehicle that I was coming back from one of these events. I was with a friend. We're going back to where our apartments are. And she mentioned to me that, hey, there's another event happening called the Founder Pitch Night. And it's specifically designed for founders to get together and discuss ideas, or prospective founders to get together and discuss ideas. And I remember being like, it's kind of late. I don't know if I want to go. And she was like, no, you really should go. So I owe Anne, my friend, or Annie, I owe her a shout out for convincing me to go that evening. So I ended up going that evening, and that's where I met my co-founder. So he presented the idea of taking advantage or capitalizing on this amazing gig economy that's coming up, and how these drivers are always in the perfect areas and driving in the right spots. So that's where kind of 2 and 2 came together, that this is perfect. Why don't we build a rideshare advertising network where we can, instead of having these like billboards that I was originally thinking, we can have basically a fleet of mobile digital billboards. You attach this monitor on the roof of a car. You build a smart network where, as the cars are driving around, you have the exact location of where the cars are, and you can show advertising content specifically curated for that location.
Nice.
At the same time, you can build in some advanced measurements when, as the cars are driving around, you have humans around the car with their cell phones. So you have some data availability for mobile device IDs. So what if you can track where the people that were around the car, did they actually take an action? Did they go to a website? Did they go to a store? Even if it's a small sample, can you, with some stat-sig capacity, be able to measure that? And that's literally all Halo is. It's a very large network now of these smart billboards on wheels. And as I drive around, we show targeted location-based advertising, and we track every single impression that goes out to see did that impression actually convert.
Amazing. So you have this idea. You go to this pitch night. You find your founder, your co-founder. You guys go start working on a thing, right? What was that process like, right? You have this idea. You're excited about it. right? There's thousands of ideas every day, Faizan, that are born out of the ground, right? But how does an aspiring founder take that idea and then go do a thing, go get money, go find product market fit? Let's talk about that before we talk about the exit.
So the first thing that I encourage everyone to do before building is just have some validation. So go out and ask a prospective customer, if I build this, will you buy it? That's essentially what I did. I had my previous network from Google where I was interacting with these large advertisers on a daily basis, so kind of knew them in a pretty personal capacity too. So I sent one of them an email saying, this is what we're thinking. If we build this, will you buy it? And she said, yes, if you build it, we will be a customer. That is basically, a screenshot of that was basically in our pitch deck, as you can imagine. Oh. It was like this very large enterprise is saying that if we were to go out and assemble this structure and build this platform, there is a demand side for it. And the second thing is you obviously also validate the supply side. Supply side was easier to validate. That was basically us going to drivers and saying, if we give you $500 a month, would you be willing to put a monitor on top that we pay for? And over time, that can make you even more money. We'll do some revenue share, or we can just give you $400 or $500 flat per month. And that can help pay for your insurance. That can help pay for some gas to some capacity. And they loved it. So that's essentially what the initial vetting was.
How do you validate her saying yes? Like, I think it's easy for somebody to be like, yeah, sounds cool. Sure, we'll buy it. But when it comes to them actually stroking a check, right, or allocating budget towards it, so how do you, in that sort of, lean startup validation phase, how do you know what's real and when somebody's just stroking your ego or telling you what you want to hear?
You truly have to think from their perspective that what do they care about? They care about cost per acquisitions in our case. So they want to be able to acquire a new user for as low of a cost as possible. How can I, so you're right, she might just be unable to say yes because she wants to make sure that my feelings aren't hurt.
Yeah.
But then the next step is, what if we just actually run an ad and test it on as small of a scale as possible and see what happens? So we competed in some pen and Wharton competitions, and got some initial grant money from winning those competitions. And we allocated that towards buying our first unit from China. It was this terrible looking monitor that came in, and with this, literally you could see all the pixels. The pixel density was one of the worst. And we managed to convince this one driver in Philadelphia. His name was Tony. We're like, Tony, can you please put this monitor on top of your car?
Sounds like a Philadelphia driver.
I know. It's a very, very Philly driver. He was a great guy. So we convinced Tony, we're like, we'll get the roof racks and everything. Just put this on just for a week or so and let us do some testing. We'll pay you a few $100s. And he's like, sure, yeah, I'll let you do this. It sounds like a cool experiment. So we put that unit on, single car, single monitor, and just let Tony drive the way he was driving. Before he did that, we installed this app on his phone so we could track the location. The reason we did that is the hypothesis I had was, as people see whatever content we're showing, they'll be taking an action. One easy way to test that without going into any client legalities was, what if we show our own content? No one knows what Halo Cars is. So no one's searching for Halo Cars. What if we just put Halo Cars on the monitor and run a Google Ads campaign and then track where the searches are coming from and then overlay that search data with where Tony's driving?
Nice.
As soon as we overlaid that over the course of 2 weeks, it became very evident that people were looking up Halo Cars in the same areas where Tony was driving. And that became another very valuable slide in our pitch deck. That was, if we went into investor meetings with just that slide in our entire pitch deck, that probably would have worked too. Because you just want to convince whoever's on the other side, whether it's a client or an investor, that what you're building is valuable. What you're building, there's a market for. And there's no better way of doing it than to say that this is what I've built. Here's what the implied cost per acquisition would have been from this campaign. And here's what our target cost per acquisition is. So as you can see, there's a large delta in the middle, which means that could be our margin. Amazing. So that's basically what we did.
So you do some initial validation. You realize we're onto something. You have some kind of early signs of, product market fit, which, I know, takes an act of God in some ways to find product market fit, right? It's very difficult. So after that happens, you decided you need to go raise some money to put something together, right? So how was that process? Was it smooth sailing, or was it challenging?
It was fairly smooth. The funding dynamics change by market, as you know. Every year is different. We were lucky in many capacities in that the funding dynamics were fairly straightforward that year. Also, we were lucky that we were building this inside Wharton Business School, where a lot of the investors. So to give you an example, the large startup competition that we had, the judges for those competitions were alumni. The alumni were like CEO Shazam or Chief Operating Officer Venmo. So people that had done pretty well for themselves and were just looking to. They were judges for two reasons. One, they wanted to give back, and two, they're scouting good companies on their own too.
Want to invest. Yeah.
So a lot of these people, most of these judges, after the competition, and we ended up winning the competition, but after that, they just literally emailed us and they said, "Can we set up meetings?" So it was almost like inbound investor interest from a pre-seed company.
Nice.
All we had was this one car showing that if you scale this could be something significant. So we had those meetings. Ultimately, I shared one of our wins from another competition on Facebook or LinkedIn or one of those platforms. And someone from my network reached out saying they represent Zumba, the dance workout.
Yeah.
So turns out Zumba was they had this informal VC arm, and they said, "Can you please come to Florida and meet with us?" We were in the Northeast. We already have this investor interest. I don't know for a very small pre-seed if it makes sense. And they were like, "Just come for a day. You won't regret it." So there's no harm. We should at least go meet them. So we fly over to Florida and we meet with the Zumba founders, and they were just exceptional. We had great chemistry. There was a lot of similar to our roots. So I'm Pakistani. My co-founder is he's half Syrian, half Cuban. So a lot of these community-based and very people-based business, which is you have relationships with people on a business capacity too, because there's some kind of likeness there, some kind of common interest there. And that's what we found there. They never negotiated on any kind of a deal that we presented. They took everything as is and just said that we are investing in you guys and we really believe you'll be successful. And they basically extended their network and they made their network our network. So it ended up being a very good match. So they were the leads for our pre-seed.
How much money did you guys raise?
We capped it at $500,000. And
is that all you had to raise, or was that from the time you started the company to the time you exited?
That's all we raised. We deliberately capped it because we didn't want to dilute ourselves too much. In fact, there were some VCs that said they wanted to invest, but we had to take $1 million or over $1 million in order for it to be interesting to them. We just walked away. Said we're going to be very deliberate about only raising $500,000. We're not going to pay ourselves. At least the founders are not going to pay themselves, and just be very diligent in how we run the business. And very, very glad we did that.
So yeah, sounds like it was some good advice from investors that caused you guys to run the business in a much more maybe responsible way than a lot of these, especially at that time, startups coming out of the ground. We're raising exorbitant amount of money. We're spending a lot of money, burning a ton of cash, and then going through these vicious cycles of raise, grow, burn, and do it all over again several times. So you guys found a way to avoid that, which I find very interesting.
Yeah, it's so important. It's just learning financial responsibility. One, as an individual, is important. That typically happens when you start college. It's the first time you have some, your work study or some part-time money coming in, and you learn what the value of a dollar is.
Yeah.
Second time that happens is when you start a business, and then it's a different scale, but every dollar is so valuable. A dollar allocated to one part of the business is a dollar away from another part of the business. Mm-hmm. So if you have unlimited resources, you don't get to learn that skill set, but I think it's one of the most valuable skill sets for a founder is to figure out how to prioritize where the next dollar goes. So I still encourage people, do not overraise. Raise exactly as much as you need to in order to survive with just the right runway. And just, if you do well, you'll be able to raise the next round.
Especially now, right? I mean, times have changed a little bit. I think investors care deeply about fundamentals and being responsible with spending and cash. And so, yeah, totally agree. So you go raise a little bit of money, you start building, and you have this, the fastest exit in Wharton school history, but maybe one of the fastest exits ever in less than a year. What happens between the time that you raise that money and the time that you're, ultimately acquired by Lyft?
We were just having a great time. It was so much fun. So we'll talk about the sacrifice portion of it later too. But at this point, it was just all felt like fun. We raised the capital. I dropped out of the program. We moved the team to New York, hired some folks, and then basically got this house that we call the Halo House.
I love this story.
It's so cliche, but it was so much fun. So we got this place called the Halo House, which was our house in Brooklyn. We literally lived there, worked there, slept there, ate there, everything. So it
All
was
the
a lot.
employees.
It was the founders and some of the employees too. Yes.
Yeah.
It's just we without knowing much about how we were doing this, we created this great culture around. You weren't working because you had to. It just was fun. Like everyone owned pieces of the business that they genuinely enjoyed working on, and we started scaling very rapidly. And because we were working a lot, we were living there, so which basically meant that all of our dinner time conversations were also happened to be about work, but in a fun way. But because we were doing that, we were able to scale the business very rapidly. And before we knew it, we were in multiple markets. Before we knew it, one of the largest ones in each market that we were in. And we started gaining some traction and some interest from a lot of the press that started writing about us. It was still far too early for us to ever even think about selling the business. But the way that whole thing panned out was we launched this product called Pickup Assist. And that basically was that when the car was coming to pick a passenger up, the driver could tap a button in our app, and instead of showing an ad, the monitor would start to show the driver's license plate. And that was meant for it to be more of a safety platform where instead of people getting in the wrong Lyfts and wrong Ubers and terrible things happening to them, they knew exactly which car they were getting into. So especially in places like New York, it's like a sea of black Toyota Camrys for rideshare vehicles. Yep. So if you have a monitor on top that's showing the license plate, it's easy to spot it.
Yep.
And we did that. We wanted that to be more fully integrated with Uber and Lyft themselves, because right now the driver had to switch between the rideshare app and our app in order to change the content of the monitor. So I reached out to both Uber and Lyft through some friends that used to work there, and asked them if they could help assist us with the right connections for the integrations. Talked to Uber. They were like, yeah, sure, we might be interested, might not be interested. Go talk to this other person instead. So they kept passing the baton to someone else. At Lyft, however, we talked to one team and they were like, well, this is kind of interesting. And then before we knew it, they had a second meeting, third meeting, fourth. And by the time the fifth meeting rolls around, their C-suite's interested in meeting with us. We're like, why is a C-suite of Lyft trying to meet with this tiny scale company on, the small product tool that we want to put on our monitors? So their chief product officer flew to New York, and we went over to the Lyft office. We staged a car outside too to make sure that the driver was there in case he wanted to go and talk to them and see the monitor.
Nice.
So we go in the Lyft office in New York, and that's where he told us that he'd be interested in. He loved what we had built in such a short amount of time, and he wanted us to work more closely together. And he asked if we'd be interested in signing the company to Lyft and going through this Aqua Hire process. And we told him that we were about to raise for our next round. We had these great VCs lined up for that as well. So we told him that we're open to it, but the numbers would need to make sense. So we negotiated for a couple of months and came to numbers that made sense for all parties. Sold the business. This was basically month 9 of running the business. And I still remember we flew to San Francisco Sunday, met with the Lyft team Monday morning to finalize the deal. And then Monday afternoon, we were in orientation sessions to get onboarded at Lyft. So it all happened far too quickly.
Incredible. You make that sound so easy. I know it wasn't that easy, but one thing that you and I have talked a lot about is this idea of an Aqua Hire. And I think when you say Aqua Hire for the tech ecosphere that exists out there, there's kind of a weird bad taste about the word Aqua Hire. And I think a lot of people chalk that up as like, oh, they couldn't build a big enough company, so they got Aqua Hired, right? You're a big proponent of this. And I think for the right opportunities, this is actually like an amazing thing for companies to go through. So why did you decide to do that with Lyft versus going and raising more money, continuing to build a company, and potentially looking for like a bigger cash or financial outcome in the future versus doing something much sooner?
Yeah, so a couple things happened. One was in our conversation, the one with the chief product officer, it became very evident that Lyft was very interested in the business. So in other words, it became evident they were going to build this with or without us. As a platform that was relying on Uber and Lyft drivers as our sole supply, we were, essentially, we felt like we were in a place that we needed to consider the offer seriously, or otherwise we would be competing with the platforms themselves. Yeah. It is not fun to compete with the platform that you're relying on. Yeah. That's the first thing. The second thing that happened is there was just a lot of good chemistry when we talked to Lyft. It felt like the values the company had were very strongly correlated with ours. So one of the reasons we started Halo was to put some money back in the drivers' pockets. One of our early employees, his dad was an Uber driver, and just seeing how much he was making in New York was very telling that something needs to be done. So that's another reason we felt passionate about building Halo, that just by putting this monitor on top of your car, you can earn some supplemental income. And Lyft was very much so. They were very interested in somewhat of a similar model too, that they really cared about the drivers. And also it felt like the structure in which they would bring us also felt exciting. And it just felt like the right time. And this we didn't know, but in hindsight, we sold the business at an incredible time. We sold it in November of 2019, months before COVID. Yeah. Building a business, an out-of-home advertising business, when the world is being told to stay at home, I'm sure all the investor interest we had would have evaporated pretty quickly. Yeah. So all in all, worked out incredibly well. The last part obviously wasn't planned. We couldn't see the future, but sure. We did believe that there was very good chemistry fit, and we also believed that there was. We did not want to be in a place where we are forced to compete with the platform itself.
Amazing. And it's, you can't get Aqua Hire unless you build an amazing team. So it's a testament to the team that you were able to put together in a very short amount of time. So I want to transition a little bit. I was doing some research. I realized that you are part of this exclusive group in Forbes called the Forbes 30 Under 30. And I think for all entrepreneurs, having a 30 under 30 badge of honor or a 40 under 40 badge of honor is a big deal, right? So what does that mean to be inducted into the 30 under 30? How does that happen? How do you qualify? And then ultimately, how were you awarded that award?
Yeah, we feel very lucky to be a part of that. It's helped us in many ways, and both personally and professionally. The way it typically works is you have a nomination process. So 30 and 30 is for each category. So every year, Forbes will select 30 people from, for example, marketing in North America. And they also have Asia and a couple other markets. But they'll select 30 from each continent in each category to be like that's like the 30 folks they deem to be representative of the industry and the tailwinds of the industry. Nice. So we got the one for marketing in North America.
We as in you and your co-founder?
Correct.
You both got it? Nice.
Yes. And the way it typically works is a nomination process. So someone from either Forbes itself or someone that's been at 30 and 30 can nominate others either in their network, someone they've heard of, and that's how the process begins. So for us, it was nominated by a friend's brother who was part of 30 and 30 Asia in the film category. So literally different continent, different category, but we shared a similar vision of being from Pakistan and leaving the country and doing some fun things that we were passionate about. For him, he went to the Middle East and delved in the film industry and did exceptionally well for himself. For me, it was dabbling in marketing in the United States. So he nominated me. I didn't really think anything would come out of it. But then Forbes reached out saying that they'd love to move forward. There was a lot of forms they make you fill out about funny questions they ask you that you're like, how are these even relevant? And that's basically what the process entails. So it's fairly quick and very, very light on the founder themselves. But it's a fun community to be a part of. They host a conference every year. So it's great to go there, see the same faces, see some new faces, and be a part of a community that we think is kind of just thinks in a similar way. But yeah, it's a fun time.
Amazing. You're also working on, and I know this because I'm part of the syndicate. At least I get the emails. You've started a venture capital syndicate, basically an investment syndicate called Distributed Capital. Why did you decide to do that? And maybe tell the audience a little bit more about what you're doing there.
Yeah, it's interesting. As founders, we're trained to just think very optimistically. I mean, you kind of have to. You're going in and creating something in an industry that doesn't exist before, and you're kind of betting on yourself very persistently. As an investor, it's a very different skill set. You're taught to be somewhat pessimistic. You have to poke the holes in companies that are coming for you and raising capital. So I always found that interesting when we were raising capital, and I wanted to also learn a little bit about the other side of the world with investing and figure out like what does that skill set look like and how can I get better at that. So after our exit, I started putting some capital back into friend startups, other startups that I had high conviction in, and just wanted to be part of that journey. And while I was doing that, other friends started coming in and saying, "Hey, you're already doing this. Can you also take my check?" Nice. And then before I knew it, that other categories started getting larger and larger. And I was like, well, I'm already syndicating this business informally. I might as well do it formally. So I started Distributed Capital with my co-founder, same co-founder as Halo. And the whole thesis was that there are so many deals that happen that the general world is just not privy to, or they don't have access to. So you want to do better, distribute the access to this deal. And that was the early premise behind Distributed Capital. Nice. That we, through our networks, have founders that are raising capital through Bain, Excel, YC, etc., all the typical prestigious funds. But how do we get a hold of that? And the way we get in is through our friends. So imagine if like you're raising capital, I'll come to you say like, hey, you're already raising capital. Can I also put some of my checks in? Mm-hmm. You'll be like, yeah, of course. Like, I know you personally. Yep. Just be in for the ride. So now we do it through a single check, and it's a syndicate. So we do deals as there's no like cadence per se, but it's typically like once a month or so. Some months could have multiple deals, some months could have 0 deals, but it's completely based on deals in our immediate networks. So if someone that I personally know is raising capital for a business they've built, and I have high conviction in the founder and what they're building, if I'm already putting my own capital in, I'll just syndicate the deal and put a slightly larger check in through others. So anybody can participate in this. There's effectively no minimum requirements for checks or any of that sort. So it's just a way for more people to be a part of these somewhat high profile deals.
Phenomenal. I think, for those who don't understand at home, the difference between a venture capital fund and a syndicate, essentially a venture capital fund has LPs, right? They have high net worth, they have institutions and others that will invest into a fund. That fund typically has a mandate, right? So they can only invest in certain kinds of deals at certain valuations, certain check sizes. And typically there's a life, right? The fund has a shelf life, and often it's 10 years instead of a venture fund. So what sort of flexibility does a syndicate provide, outside of like being able to let anybody and everybody sort of invest, which you just can't do in any venture capital fund? What other maybe flexibilities does a syndicate provide to make it easier to get checks into companies than a traditional fund?
Yeah, it's amazing actually. The more I learn about the process about being in it, the more I love the syndicate world. There's no pressure to deploy capital. You can deploy capital so a typical fund, as you mentioned, there's some restrictions associated with how much capital you need to deploy. Yeah. There's also a management fee component. So if you are an LP, part of your investment is going to pay for the fund's operations. For a syndicate, you have none of that. There's no management fees. So the syndicate owner or the GP for the syndicate, such as myself, we only win or we only get returns if there's actually a return that happens for one of the portfolio companies. Yeah. So the incentives are beautifully aligned. Whereas in a VC, typically the incentives are, in my opinion, slightly misaligned, where the more money you're deploying, the more management fee you're collecting. Yeah. So we have none of that. It also helps that in a syndicate structure, so yes, one, there's no pressure to deploy capital. 2, you don't have to abide by any like stage of investment, such as series. You're only going to do Series A and beyond, or any kind of a specific industry you have to invest in. Everything is fair game. All we're doing is we are basically packaging up an investment and presenting it to the people that joined distributed capital and saying, this is what we're going to invest in. You're welcome to be a part of it. You're welcome to ignore this. Either way, completely your choice. So it's about giving the optionality back to the investor. In a VC world, if I invest in a VC, I don't exactly have a say in what's being invested in. I'm basically investing in the fund, and the fund owner or the fund runner has full flexibility in what to invest in. So it also is a better accountability, honestly, for the person running it versus a traditional venture capital fund. So we have about a little over 800 members now. So it's grown quite a bit over the past. It's been less than a year that we started it. It's been really fun.
Now, do you have to be an accredited investor to invest in a syndicate?
Excuse me. You do, unfortunately.
Okay. I wonder if any of that's going to change ever. I think it's actually pretty interesting. They still require that, given the flexibility in how you can move money and deploy capital in other sectors. Do you have any thesis on that? Do you think that's going to change?
I hope so. It is unfortunate that that's how it is, because it's in most other significantly higher risk investment categories.
Sure.
You could do whatever you want. You can invest as you please, but for the VC world, especially because the returns can be so disproportionate compared to other traditional investments, it would be amazing if more people would be able to invest. But unfortunately, and it comes from the federal government, there is strict restrictions on being an accredited investor in order to be able to come in. And we tried figuring out if there are any loopholes or any other way to get more people in, but it does seem like, at least for now, you need to be accredited.
Yeah.
That's one restriction we couldn't get around.
I wonder if there'd be a way to set up an entity, right, that becomes an LP inside of the syndicate, but the entity is backed by non-accredited investors, but you could build the value of the entity up so much that the entity itself could be an accredited investor to invest inside of a syndicate. So almost like a syndicate of syndicates. Have you thought about that loophole? Is that a thing, or is that crazy?
Potentially. I mean, you might be incriminating yourself right now, but I'm kidding.
Yeah, I don't know. This is not investment advice by any means, but I do agree with you that I think it's I don't understand why you'd have to be accredited still to participate in a syndicate. Faizan, this has been amazing. I have one final question. I think there's going to be a lot of listeners who, like you, early on, feel stuck, feel like there's a ceiling, feel like they, maybe they have that builder or growth mindset. They want to start a company, but they don't know how. They don't know what to do. They don't know what type of company they're going to start. What's maybe your best piece of advice that you'd offer to those kinds of founders to make that dream a reality?
I think all of it just comes back to betting on yourself. So if you can bet on yourself and take some systematic or calculated risks, that's basically how you're going to learn and extract some value out of this. There'll always be roadblocks. There's always going to be an easier path to take. So, for example, at Google, I could have stayed there longer, as you mentioned, and just build some kind of a career out of that. But it's just, if you're trying to unlock true fulfillment and trying to build something that is truly yours, and I just think a certain level of risk tolerance is appreciated. And we live in a world where it's not, as mentioned before, the barriers to starting a company are not that high. So it truly does end up coming down to just putting your foot down and saying, you know what, this is it. I am going to try this out. The worst case scenario is status quo, which I think a lot of people don't think about. That if what you try ends up failing, you can always go back and do what you were doing before. So it's not that you're giving everything up, putting the entire world on the line to go and run some experiments. The cost of running an experiment is very low. Cost of building an MVP in most cases is fairly low. So just getting an MVP out there, getting some initial validation, no matter what the idea might be, I think it's very fruitful is to go through that exercise, and then the answers alone should be hopefully convincing enough for you to take that leap of faith, bet on yourself, and then go build whatever you're going to build.
Amazing. We're going to wrap on that. Thank you so much for joining. It was a pleasure to do this interview with you and have you on the show.
Thanks. Of course. It's been an honor. Thank you, Tyler.
Thank you for joining another episode of the Rollercoaster podcast. This was episode 3 with Faizan Bhatty. It's close. It's not going to be perfect. 3 things that I want to call out, key learnings that we learned from Faizan today. Number 1, before you start building something and spending a bunch of money, make sure that you vet the market. Ask the people who are going to be buying your product if it's something that they would use, and potentially go even further and spend some marketing dollars and invest and see people's interest before you dive 2 feet in. Number 2, the Halo House. The team camaraderie component of that I think was amazing. And early on in startups, I think it's incredibly important to build that camaraderie up. Doesn't mean you have to go buy a house or an apartment and shove everybody in there and work 24 hours a day around the clock. Not necessarily, but the camaraderie piece I think is huge. And 3, that last point, bet on yourself and take calculated risks. What's the worst that can happen, right? I think, anybody who's watching here, you're probably talented enough that you're in a career profession. The worst thing that can happen is you fail, and you can go right back and get a job if you choose. But take those calculated risks, bet on yourself, and thanks again for joining the Rollercoaster podcast. We'll see you on the next one.